The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Do you focus on what could go wrong, or do you focus on what's already going right? Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Scarlett Fu. We're kicking off to the closing bell here in the U.S. You know, we began the day with gains in stocks, bonds, and the dollar, but
did we? I missed that.
I know, it was really brief.
All
right, let's take a look at where things stand right now, because we lost some momentum in equities, and the S&P 500 is now down for the first time in 7 days. So this marks the end of a 6-day record run if we close at these levels. And the Mag 7, a pretty mixed read so far, as 4 of them report this week, starting with Meta and Microsoft tomorrow after the close. We are looking, of course, at lower yields as bonds do continue to hold on to those gains. So 10-year now 4.32%, down 8 basis points. And the dollar continuing to extend its gains. The Bloomberg Dollar Index remained at a 5-week high, gaining versus all the G10 currencies.
Yeah, really turning it into one of the more intriguing stories of the past few weeks. Meanwhile, on the day, while there is no rally in equities, there is a modest rally in treasuries. The first rally in 5 days and the strongest rally in 5 weeks, as 2-year yields now dipping amid a solid report on U.S. job openings and an even stronger report on consumer confidence. It's a pattern of upside economic surprises for a market that, hey, just 3 months ago was primarily pricing in downside economic scenarios.
This 3-year, what I would call soft recession that we've been living through now, we're sort of coming through that, and we're getting more visibility on that. That's why we're more constructive on the next year. Now, in the next 3 months, I do think that some of the things that people have been worried about could start to play through earnings.
And of course, one of those worries remains trade. Despite progress on U.S. deals with Japan, the UK, even Europe, the IMF today warning that the world economy remains vulnerable to trade shocks. A global economy that's not only struggling to adjust to the shifting sands on tariffs, but also to the weight of uncertainty from lingering geopolitical tensions, high public debt, and renewed inflation pressures. At least that's what the IMF says. And while folks tend to be a little bit dismissive of IMF's forecasts, they're less dismissive when that message is coming from Wall Street. Peter Oppenheimer, the case in point, chief strategist over at Goldman, saying in an interview with Bloomberg that he sees a real possibility of tariffs hurting stocks, particularly as valuations continue to creep up, as the risk premia continues to creep down. In his view, Scarlett, a sign of market complacency.
Yeah, and of course, when you talk about risks, as far as risks go heading into tomorrow's Fed decision, those are fairly low. No rate changes expected, and an updated economic outlook won't happen until September. So the biggest question is whether anyone formally dissents in favor of rate cut. Now, under Fed Chair Jay Powell, his tenure has seen a couple of dissents here, represented by these lines right here, and to a large extent by the stretches of no lines. As Bloomberg columnist John Authers points out, dissents were fairly common in the 1970s and 1980s, but have grown pretty rare since then. The only previous period as calm as this one was just before the financial crisis, right around here, which may be concerning Romaine in its own right.
All right, joining us right now to kick us off to the close is Kathy Jones, Chief Fixed Income Strategist at the Schwab Center for Financial Research. And Kathy, as we speak, the Fed presumably meeting right now, presumably having a debate about where they should go next with monetary policy. While we aren't expecting any changes in that decision tomorrow, I do wonder, as you look ahead to September and beyond, are you as confident that we are going to get those 2 rate cuts that are on that dot plot for 2025?
Well, I wouldn't say my confidence level is high, but we do think a September rate cut is still likely. I think, and we've been saying this all year, we think that the impact of tariffs and some of the DOGE cuts and some of the slowdown in the global economy will start to show up late summer and early fall, enough that there's ammunition for the Fed to cut rates. But it's still tenuous in the sense that although we're seeing some slowdown in the labor market, we're seeing some slowdown in economic growth in various places, we're still seeing an unemployment rate that's pretty low, and we're still seeing inflation that's a bit too high. So the Fed is really caught between these two forces that make up their dual mandate.
Where do we stand right now when it comes to market expectations of inflation? And I ask that against the backdrop of all of the public pressure we've seen from the White House on Jay Powell, and whether that maybe erodes what would normally be under the Fed's control with regards to steering and keeping those expectations anchored.
Well, a couple of ways to look at it would be to look at what's implied in the TIPS market. And the TIPS market shows, maybe 2.3%, depending on which tenor you use. of inflation longer term, which is at or above target. The other way to look at it is the term premium that's embedded in 10-year notes. Some of that's going to be inflation driven, some of that's going to be driven by other forces, but that's been creeping higher and higher. And I think that when we look at this, we don't really see the expectation of getting solidly back to 2% and staying there. It looks to me more like the market's telling you maybe 2.5-ish is as good as it's going to get in terms of inflation. A lot of this is driven by the tariffs. Some of it's driven by immigration policy and its impact on the labor market. And some of it is probably driven by the high and rising deficit and the fact that Washington seems much more eager to boost fiscal activity than to counter overheating when it might happen.
You know, Kathy, the Treasury refunding announcements have kind of become a big deal for the bond market. We learned yesterday that the U.S. government intends to borrow more than $1 trillion in Q3. That was more than expected. And of course, the second part of the announcement comes tomorrow at what maturity that Treasury will be borrowing at. Is this a risk event that investors need to position around?
You know, I don't think so. I think people who are kind of into the weeds in this know that a lot of it's going to be T-bills. And that's partly because we're still operating under the debt ceiling limitation, and partly because that's where the market demand is. Issuing T-bills is where, you know, the Treasury has to meet the market where it is, and demand for Treasury bills has been extraordinarily strong, especially from foreign accounts, not foreign official accounts, but foreign private accounts. So what we're seeing is, to the extent that we are still drawing in capital, we're drawing it in at the short end of the yield curve. But I think it's also this constraint of the debt ceiling and the fact that it really doesn't make any sense if you're trying to manage the balance sheet to issue a lot of longer term notes at this stage of the game. So I don't think it'll be a real surprise. $1 trillion is a lot for the market to absorb, no matter what the maturity of the debt. But I think it will get done pretty reasonably well.
I like what you say about meeting the market where it's at. But in terms of all this bill issuance, what kind of risks does that increased bill issuance perhaps create?
Well, you know, I think the issue is just that you have to find the buyers, right? You know, how high do short-term rates need to be to draw in that capital? And then what happens down the road? You roll over those T-bills over and over again. You know, at some point it has to be probably absorbed at some other place in the yield curve. But that's probably a 2026 story, not a 2025 story.
Kathy, I'm curious as to, when you look at the health overall of the economy and of the markets, you know, sort of in turn with that, there's been a lot of discussion about how tight we're seeing spreads, particularly in the corporate fixed income space. We're in the middle of earnings season, this week the busiest out there. As you start to get a little bit more clarity, or at least a little bit more guidance from some of these corporations out there, are you walking away with a healthier picture of corporate fundamentals, or should we maybe be looking for cracks in those fundamentals?
Well, you know, what's interesting to me is we've seen some deterioration in corporate fundamentals from the debt management side, and yet the market, the bond market, has not responded to it. So those credit spreads are very, very low, very tight. You've seen some dispersion, say, in the high yield market with lower rated credits, seeing their spreads wider. But really, I don't think the market has reflected what I think is the risk to corporate earnings and the quality bonds out there. I don't look for a big problem. I think longer term, you know, most large corporations are still in very good shape, but it is not the case where the market is really reflecting some of those underlying risks, which is why we focused really on higher credit quality bonds and limiting exposure to high yield, in particular, or very low rated investment grade bonds, because you're just not getting paid to take the risks, and the trend is not in the right direction.
All right, Kathy, always great to talk to you. Kathy Jones, Chief Fixed Income Strategist at Schwab Center for Financial Research, with an eye on the data and an eye on that Fed decision tomorrow. And today we have a big eye on trade deals, specifically that EU trade deal, a conversation up ahead with the EU ambassador to the U.S. We're going to discuss that trade deal and the economic ramifications that it will have for all the countries involved.
Plus, Astrazeneca CFO Aradhana Sarin joins us to discuss the pharmaceutical giant's plans to boost investments in the U.S., its fastest scoring market.
And earnings are taking off, but what about travel? Booking set to report earnings after the bell. So too is Caesars. A conversation with Clint Henderson, managing editor at The Point Sky. Stick with us. This is at the close on Bloomberg.
The EU and U.S. racing to finalize a trade deal that would slap 15% tariffs on most of the EU's exports to the U.S. The agreement made over the weekend putting pressure on the euro. More details still need to be worked out on a final deal, with EU officials pushing back on concerns around the economic ramifications. Our next guest has a central role in facilitating relations between the U.S. and EU. She joins us now live. Jovita Neliupsiene, European Union Ambassador to the U.S. Madam Ambassador, thank you so much for joining us. When we look at the moves in European markets, European stocks, and the euro, it would appear that the financial markets' verdict on the trade deal is that this was not the greatest outcome for Europe. How do you think investors should interpret this trade deal?
Well, first of all, it brings stability and predictability for their markets. This is what all the business we were engaged on both sides of Atlantic, be it in Europe, be it in the United States, were actually asking and craving for. So I think this is one of the positive sides. Another thing, we have to think, what would be the alternative? And we had received the President Trump letter, which actually indicated that the tariffs could be 30% and not 15%. So I think that going into the trade war will be probably the worst possible situation. So having a deal, we can really work through the details. Having a political deal, we can work through the concrete details and get it done, and then focus on what we know best, transatlantic cooperation.
Now, what happens next, of course, depends on how European multinationals and industries respond, whether they will absorb the tariff impact or do what, say, LVMH has been doing, which has promised to build new factories in the U.S. in hopes of mitigating the tariff impact. How are they coming to the EU to ask for guidance, or how are you guiding companies?
Well, I think, first of all, we have to finalize the paperwork. We have to finalize the statement, so it will bring even more clarity when we have it written down. It will be clear what kind of the tariffs we are talking about, because there will be a specific treatment for the strategic sectors such as aircraft, certain chemicals, certain drugs, where the tariffs will come back actually to the pre-January level. There will be definitely products which will be charged 15% of tariffs. What is important, it will include most favored nation status tariffs, which we already have. We still have to work out on steel and aluminum. So there are a lot of elements which are not yet written down, and we have to work through those details. So my advice, if it would be given, would definitely be really let's patiently wait when we have the finalized deal.
I am curious, though, and I know it's going to take a long time before we get there, Ambassador. Were there any sort of requests by the U.S. that the EU avoid any deals with other nations or regions that could potentially be in conflict with whatever you've agreed to with the United States?
Well, look, we have more than 60 deals around the world, and we are continuing negotiating other trade deals. We just finalized the deal with Indonesia 2 weeks ago. We finalized the deal with Mercosur, and the negotiations with India are ongoing. So we have our own deals and our own commitments. I think that what happened over the last 3 months, I have to admit, we focused on EU-US deals and conditions in which the trade could be possible, and that we can come back to those predictable, stable trade relations.
You have to also, though, not necessarily you specifically, but obviously EU leaders are going to have to sell this to their own populace in each individual nation. We've already seen a lot of concern and pushback about the potential hit to economic growth in specific countries that are very export dependent. What is the message that you bring to those folks in being able to address those economic concerns?
Well, trade tariffs, were never our choice. if we would have a possibility, we will definitely not go that way. For us, tariffs are the measure of last resort. There will be consequences, definitely. Well, on one hand, because some of their tariffs on our side will be zero, so our consumers actually would enjoy possibility to get cheaper products from the United States. On the other hand, definitely, when we will export, it will be more expensive. Well, I think we can have a pretty clear view that some of the cost of those tariffs will be passed on consumers here in the United States.
Just give us a sense of when we might be able to expect any kind of detail or firmer decision on European wines and spirits.
Well, I think that all the decisions which are related with the very specific products which were not yet outlined publicly will be in the statement, which we hope to finalize in the really near upcoming days before the August 1st.
All right, Ambassador, appreciate you taking time for us. Jovita Neliupsiene, the European Union ambassador to the United States, as we, of course, now have to get through the really hard work of actually taking that framework and turning it into an actual deal. A lot of negotiations ahead in a market that's going to have to parse it all, and they're going to have to do that in between a slew of earnings coming down the pike over the next few days. That includes Starbucks. Their earnings are coming after the bell tonight. We're going to preview what to expect when we come back after the break. This is The Close on Bloomberg. All right, let's get right to our top calls. Big movers on the back of analyst recommendations, and we start with the apparel maker Tapestry. Bank of America downgrading to neutral, adjusting its price target higher to 115 from 95. A nod to the recent rally, with the analyst still having confidence in the momentum at Tapestry's Coach brand, but says the rally has brought the stock close to fair value. Those shares having their worst day since mid-June. Up next, Lionsgate, Wolf Research, initiating coverage of the movie studio with a pure perform, citing the company's valuable library and cost-cutting opportunities, but says those positives are outweighed by balance sheet complexity and eroding fundamentals for the mid-budget films that Lionsgate specializes in. Those shares down 4.5%. And finally, Domino's Pizza, RBC slicing their rating to sector perform, the price target dropping to 500, the downgrade coming after earnings trailed estimates and ahead of Wall Street projections for slowing U.S. sales growth in 2026, a 1% drop on that stock, down for a second day, and those are some of our top calls. We do want to stay in the world of food and beverage and in the world of earnings. We're expecting earnings out of Starbucks after the bell tonight. The coffee chain expected to report yet another drop in same-store sales. Sharon Zackfia joins us right now, head of consumer equity research at William Blair. She's got a market perform rating on the stock. All right, Sharon, I'm not sure how much last quarter matters for investors as much as the projections going forward or the guidance that the CEO and the CFO are willing to give. Do you have any sort of expectation that the turnaround that we're all waiting for might actually be a little bit clearer after tonight?
Well, I mean, I think you're exactly right. There's going to be less focus on the June quarter and more on what might be working to influence the future. This is not a company that's providing guidance right now, so we are likely not going to get some kind of concrete numbers. But I think the hope is that we'll hear more about some of the things that they've been working out from a labor standpoint that maybe is helping drive throughput or improve service. Maybe some things along the lines of the mobile sequencing test that they're doing to better align mobile orders with walk-in orders. So I think we're all going to be looking to what are the signs on what could turn sales in the future, because I don't think we're kind of there yet.
I'm not sure exactly like how much you've gone into Starbucks stores as of late, but I mean, since Brian Niccol has taken over, have you noticed physically any material changes in some of the stores that maybe you've visited?
We're seeing a lot of testing. I mean, we've run into some of the tests that they're working on. We've had a chance to talk to some of the leads at the stores about the tests. And I think there is optimism at the store level that there are going to be tools in place to help the employees basically have an easier job, right, and better service customers. But this is a journey. And I think the journey will involve incremental labor hours at the restaurants. And then that just leads to the question on what the flow through is of better revenue to profit as we get into next year. The expectations for this year were always pretty muted, but the street's looking for a high teens earnings growth next year. And that may be a tall order given all the labor investments.
You mentioned how the focus is on those stores and trying to perhaps raise labor hours to meet the new demands of investors and customers. This focus on higher store staffing and improved hospitality does increase costs overall. How patient are investors willing to be with the cost structure here?
It's a great question. I mean, I think there's a lot of belief in Brian's ability to turn this around. But I think the optimism that this was going to be a short duration turnaround has really waned. And you've seen the stock kind of tread water. I think it was in the, around this price point when they announced, that Brian was taking over the reins at Starbucks. We've had ebbs and flows in the almost year since then. But some of that initial optimism that this would be a hockey stick recovery has definitely given way to kind of the reality that this will be a little bit more of a journey.
Yeah, I noticed as well that you cover Chipotle. You have an outperform rating on that stock. You have a market perform rating on Starbucks. Given that you know Brian Niccol's work from Chipotle, what else do you expect him to kind of bring over from his time at Chipotle to Starbucks?
I mean, they're very, very different businesses. But I think, what Brian has always done very well is he's a very good leader. And that's something that translates across different types of businesses. Now, the operational dynamics of Starbucks are very different than Chipotle, and that's been clearly a learning curve, as you would expect. But I think he's been very effective already on the marketing side. We have seen, last quarter, the March quarter, the top of funnel start to improve for Starbucks. And that is good, to start bringing in more non-rewards members. That's basically an optimistic sign of the underlying appeal of the brand. But clearly we need to get the rewards members to start to up their frequency as well. That might be an easier ask once we get past lapping this period of heavy discounting, which will essentially start to happen as we get into the month of September.
All right, good stuff. Thank you so much, Sharon. Really appreciate your joining us. Sharon Zackfia is head of consumer equity research at William Blair before Starbucks reports after the earnings close today. Now, coming up on the close, AstraZeneca CFO Aradhana Sarin joins the program to discuss the drug maker's revenue topping analyst estimates and whether the company could start selling some of its medicines directly to patients here in the U.S. Keep it here. This is The Close on Bloomberg.
3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Scarlett Fu. And of course, we're looking at companies reporting earnings, not just here in the U.S., but overseas as well, especially those that are highly dependent on the U.S. market. AstraZeneca, for instance, rising on better than expected sales and profits for the quarter, thanks to its stable of cancer medications and growth here in the U.S. The U.S. a big, big part of its strategy. Yeah, a big part of the strategy. And of course, it's also now pharmaceuticals. We should say drugs have become a big part of tariff and trade negotiations. Yes, they have. Howard Lutnick, the Commerce Secretary, speaking on another network earlier today, was talking about how much pharmaceuticals were a part of getting the EU trade deal done. And he says that President Trump is actually scheduled in a couple weeks to roll out a broader pharmaceutical policy. But the gist of it is basically make all your drugs here in the U.S. or pay a tariff. Right. We've heard that before. Even though there's disagreement between the Europeans and the U.S., they don't know exactly how it's all going to play out. But I guess that'll all get sorted out as we go forward. In the meantime, I want to bring in the CFO of AstraZeneca, Aradhana Sarin, who joins us now to give us a little more scope on what she sees from her corner. Thank you for joining us.
Yeah, thank you for having me, Scarlett.
So as we mentioned, you've turned into this oncology powerhouse where you're increasingly relying on the U.S. market, where you see a lot of growth, the fastest growth, and about 40-something% of your revenue. You've also pledged $50 billion in spending in the U.S. investment by 2030 on R&D. Can you give us some sense of how you plan to deploy that? That's a lot of money over the next 5 years.
It is. It's definitely a big commitment to the U.S. So last year, in May of last year, we actually set a very ambitious target for 2030. We set a goal of $80 billion in revenue for the whole company, which was almost 2x our revenues in 2023, and 20 new medicines to be launched by 2030. And our ambition is half of that will come from the U.S. Today, it's slightly low 40%, and we're seeing strong growth in the U.S. So the $50 billion that we plan to invest is a mix of both R&D as well as manufacturing. And over the last several years, we've actually been very purposeful in increasing the amount of R&D investment as well as clinical trials that we do in the U.S. And the U.S. is a great market because it provides access to novel medicines, to patients as quickly as they can be approved. Physicians are very eager to have the best therapies for their patients. So it made sense to have more R&D investment here. And then from a manufacturing standpoint, we already have 11 manufacturing sites in the U.S. and most of the majority of manufacturing for the U.S. market is done in the U.S. And so this was another opportunity to make another investment for our future drugs.
So I assume part of this as well is to mitigate the impact of any new tariffs too, or at least the thinking might be there. Do you have any indication that this commitment would be enough to get exemptions from tariffs?
So it was not really as much driven by tariffs because, as I mentioned, we already have pretty segregated supply chains, and the majority of our manufacturing for the U.S. market is already in the U.S.
But not all of it, though.
But not all of it. There's a minority that is sourced from Europe as well. And what we've already started to do, because we have capacity in our plants in the U.S., is to do tech transfer. So what that means is looking at the same exact process and replicating that in the facilities that we have here for the drugs that are still imported. And that whole process should complete, within a year and get the new products manufactured in the U.S.
Does that change your cost structure at all for those specific drugs in those specific markets?
It shouldn't majorly change our cost structure. The new investment that we announced in Virginia is actually for small molecules, and that's for drugs that are still in our pipeline, mostly cardiovascular drugs. So we have an oral GLP-1 drug, an oral PCSK9 drug, and an oral hypertension drug. So it's more for those medicines that we would have needed to invest that money anyway, given the portfolio.
And you've got a pretty big pipeline now, at least a dozen big drugs that the market is waiting on. I'm sure there's a lot more in there that we don't know about. That takes a lot of money, and there's been concerns about your ability to raise money and to do so in a cost-effective way. One solution that has been put out there, and I know that the CEO has at least been asked about this, is the idea of moving your listing out of London into the United States, where in theory you would have greater access to capital at potentially more favorable rates. Is that still on the table?
So I won't speculate. I know there's been rumors, and we don't really comment on rumors, but we have all the access to capital that we need at present. So, our investor base
at a favorable
at a favorable
price?
rate. Yeah, we're investment grade rated. Our leverage is less than 1.5 times. We were upgraded by Moody's and S&P, so we do have access to the bank market, the bond market. So that's not necessarily an issue. Also, from an equity standpoint, our shareholder base is very diverse. So a lot of our shareholders, more than 40%, are already in the U.S., and we have pretty global shareholder equity base. So I don't think it's a access to capital thing, but it is a major market for us. And between R&D and manufacturing, we are investing here more.
I'd love to get your take on M&A as well. Where in Astra's pipeline are you looking to perhaps buttress with M&A?
So we are very strategic when we look at M&A, and mostly we're focused on either new technologies or new products in areas that we're already in. So we've defined certain therapeutic areas such as cardiovascular renal medicines or oncology or hematology where we want to be the leader, the top three in the world in those markets. So a good example is a transaction we closed in the second quarter, a company called EsoBiotech, a small biotech company, which is doing in vivo cell therapy. It's really at the cutting edge of what cell therapy could be curative treatment. That's not a technology we had in-house. And that may be a high-risk technology that never pans out, but if it does pan out, it could have very great reward. So it's those types of things that we would add to our portfolio, where either it's a technology or a drug which fits very well in our portfolio.
How about weight management drugs?
So we have an oral GLP-1, which is a weight management drug. And our strategy in weight management is a little bit different. So it's an oral medication, so it's not an injectable, which is the current therapies on the market. And we're also looking at the weight management drug and combining that with drugs in our pipeline, because most of the patients that have weight issues or are overweight also have a lot of comorbidities. So those patients may have hypertension, or they may have high cholesterol, or they may have, so it's combining those drugs, which is our real strategy.
I am curious back on the M&A point and the idea of just trying to find those companies. I know the process that drug companies historically have gone through. It's, there's been a pretty interesting symbiosis between the mega players like Astrazeneca and the upstarts. But there's been a lot of discussion about the acceleration of drug discovery, obviously with new technologies, including AI, and whether that also means that the M&A process has to accelerate. I spoke with the drug executive 2 weeks ago who talked about the prices that some of these companies are asking for at their age and maturity is much earlier and much higher than what it used to be in the past.
Yeah, I'm not sure that's necessarily a blanket sort of view. I think cutting-edge technologies will always command a premium, but there are also a lot of biotech companies in the universe that are just doing Me Too or very incremental type of innovation. So I think it depends on where you fall in that innovation curve. And companies that are really doing cutting-edge research will probably command a premium. So I think it's a wide spectrum.
All right. And is it hard to determine that, to sort of separate the wheat from the chaff?
It is always hard. I mean, our teams are constantly scouting the universe for what's, the latest technology, but it is also risky, right? Something that may not see the light of day from a market standpoint for 5-10 years, but you're making a bet on a certain technology today. So, a lot of that depends on the skills and the judgment, and therefore we are very, you want the best people who can make those judgment calls. All
right, Aradhana, really appreciate you stopping by today. Aradhana Sarin is the CFO of the drug maker Astrazeneca. When we come back, we're going to stay in the pharmaceutical space, and we'll talk about a different stock that is actually headed for record losses. This as the GLP-1 business slumps. Are we not losing weight anymore, Scarlett?
I didn't get that memo.
This is The Close on Bloomberg. Novo Nordisk shares plunging. The ADRs here in the United States on a worsening outlook for its weight loss drug business. Investors also expressing a bit of disappointment with the company's new CEO, a company insider. Altogether, we're seeing about $70 billion wiped off of Novo's market value today. The ADR is down about 20% right now. Joining us right now is Madison Muller, who covers Novo and we should just say the GLP-1 space for us here at Bloomberg. And that's actually where I want to start. I mean, overall, we're talking about a company that basically said, look, we're cutting our sales forecast. Growth is only going to be, 8 to 14%. And I know that's well below, the 20, 30% growth rates that we had seen in previous quarters. Is this sort of the beginning of the end for GLP-1 as a sort of growth story, or is this something more specific to Novo and its execution on that story?
It seems like it's more specific to Novo. I mean, we see Lilly continuing to really dominate in this space and to, bring investors' excitement into this, and they have new products, next generation products coming out. They've been really aggressive in going after these copycat weight loss drugs that Novo's been having more of a problem with. It seems like it's Novo specific, and I think investors had been hoping that the new CEO would be someone who maybe knew the American market a little bit better or was an outsider that could come in and sort of bring a fresh perspective into the company, and instead they chose someone who is very much like other CEOs at Novo. He's been at the company for 3 decades. Novo tends to, lean toward insiders, someone who is not based in the U.S., although did spend a bit of time and grew up in the U.S. So I think that there is some hesitation and some doubt about whether or not this is really going to shake things up in the way that they need to.
Is the problem that Novo Nordisk is a bit of a one-trick pony?
I think that they hope that they aren't, obviously. Investors hope that they aren't. They did seem to rest on their laurels a little bit with Ozempic and Wegovy. I mean, this wonder drug semaglutide that they thought, nothing was really going to get much better than that. And the reality was that science really did get better than that. And Eli Lilly and other companies have sort of leapfrogged them in the science. And they have struggled to make something that is really that much better than the next generation products that are coming onto the market.
Well, you've been covering this since the start, so I am curious as to where that process is right now. I mean, we just had the CFO of Astrazeneca. She mentioned their oral pill, and obviously a lot of other pharmaceutical companies either have a shot or a pill in the works. I mean, what are we doing now? Are they just recreating just the same thing that Wegovy was or Ozempic was, and just maybe just making incremental improvements? Or are we talking about completely new, different transformative drugs?
We are talking about completely new transformative drugs when it comes to a couple of different areas. I mean, AstraZeneca is developing an oral medicine. Orals are going to be the next big thing in this market. We've talked about that before. Right now, the drugs that are on the market are shots that are taken weekly, and not every patient wants to take a shot, especially when you go outside of the U.S. and these drugs aren't super accessible in other countries right now.
Or here in the U.S. for people who are scared of needles, like somebody.
Like many people, yeah. So this is going to be more convenient, cheaper, and open the market up.
Madison Muller, thank you so much. Our expert on all things pharmaceutical, particularly
I don't like needles, Madison.
Jason
like when they
Fry,
take my blood, I always look
CIO of Glenmede joins us next. This is The Close on Bloomberg.
I don't think the market has reflected what I think is the risk to corporate earnings and the quality bonds out there. I don't look for a big problem. I think longer term, most large corporations are still in very good shape, but it is not the case where the market is really reflecting some of those underlying risks.
Kathy Jones over at the Schwab Center for Financial Research kicking us off to the close 50 minutes ago on a day where we are seeing one of the more meaningful moves lower in yields that we haven't seen in a few weeks. And at the same time, seeing a relatively meaningful move lower for equities.
Well, relatively speaking, because we haven't had a 1% move in the S&P 500 in what feels like weeks. And this is another day of a modest move, albeit to the downside, which we haven't gotten for 6 straight days. Record highs the last 6 straight days.
Yeah, and so a bit of a, I was going to call it a reprieve, but I guess just a little bit maybe of a pause. I mean, look, and there's a reason for it. I mean, you've got some major earnings that could reshape this market over the next couple of days, a Fed meeting that could reshape this market over the next couple of days,
Jobs report.
Economic data that could reshape. Oh, and did you know there's a tariff deadline?
That's coming up on August 1st. Yeah, we also, of course, had earnings from a couple of industrial companies that discouraged investors, UPS and Carrier specifically, helping drag the industrials group lower.
Yeah, I was really kind of surprised on the UPS side. I thought they would, I know they have some idiosyncratic issues, but I thought they would do a little bit better. Carrier was also a surprise too, because their last few earnings reports have been relatively resilient, even in the face of all the concerns about tariffs and economic uncertainty, blah, blah, blah.
Right. In Carrier's case, it was a failure to boost its full-year outlook, whereas in UPS's case, it was not even providing any full-year outlook, showing the lack of transparency out there.
And just a reminder, after the bell today, we get several earnings that could also move the needle, including from Starbucks, Mondelez, Visa, as well as Booking.com. Let's bring Jason Pride into the conversation, Chief of Investment Strategy and Research over at Glenmede. And Jason, I do want to start off with the earnings picture as it starts to unfold in a big way over the next couple of sessions. It gets to this idea of a market rally and the idea of whether corporate fundamentals are indeed supportive of that rally.
You're exactly right. This is the biggest week for earnings. We've had about a third of earnings reports so far. We're going to get a third, roughly, of the earnings season just this week alone, which will shape people's perceptions as to whether we have growth. And really what it comes down to is whether companies are able to deliver growth in this environment. This was an environment this last quarter or two where people were kind of hit by headlines left and right, tariff-wise or otherwise. And there's this question as to whether the economy and market could continue to grow through this. If you look at earnings, originally there were expectations for about 5% growth. We're now up to about 6% growth during the quarter. It's generally looking relatively resilient. The only difference to that is that there's actually a good amount of dispersion among companies. Tech is leading the way, communications right behind that, or right in the same ballpark as that, and energy is the soft side of the earnings spectrum. So there's a big disparity in earnings, but generally when you aggregate it all together, 6% growth is decent enough for investors to continue to kind of chug this economy and market along from perspective of being okay with that growth rate.
Well, this gets to the idea, too, as to the idea of multiples, what's actually cheap, what's overvalued. If you look at the S&P 500, you certainly have a forward PE ratio that is above recent averages. However, if you take a look at mid caps or even small caps, you have PE ratios that somewhat elevated, but still below some of their long-term averages.
It's very well put, Romain. The large cap stocks are sitting at, by our calculations, about the 84th percentile valuations, meaning that in general, they only set higher than that about 16% of the time. That's not nosebleed territory yet, which is 90th percentile and above, but it is relatively high. When you look across the broader marketplace, when you look at mid caps, small caps, international stocks, generally speaking, you see things that are more near fair value. Now, reality is they haven't been delivering the same magnitude of earnings growth as the S&P 500. So a lot of investors have been wanting to take that overvaluation because that's where you're getting the growth. But as we move into the next couple of quarters, what's changing is that disparity in growth, even between large and small companies, is starting to get smaller. And therefore, the justification for that disparity in valuation is getting weaker. So we would expect that a investor that takes an approach of broadening out their portfolio will be better positioned in this environment.
When you talk about broadening out your portfolio, what are you referring to? Geographically, or in terms of size, or in terms of factor?
Yes. No, I'll give you a more detailed answer than that. Generally speaking, what we want to do is we want to get away from the singular focus trade that everybody's been after. It's not that we don't want to own that. It's just that we want to own something of everything else. Smaller capitalization securities have definitely caught our eye. We think the valuations are there. We think the growth is actually coming there a little bit faster than what we're seeing in mid-cap territory, and maybe even a little bit faster than what we're seeing in like the equal weighted or bottom end of large cap. Small cap is starting to speed up on a faster basis. Internationally, it's actually a little bit more about the currency play than it is about the companies. The companies are okay, the growth is okay, but the currency there is actually what's important. We're seeing an environment that is gradually, not necessarily collapsing the dollar, but unwinding the dollar trade that's been in place for quite a long period of time. The dollar got up to about 2.5, 3 standard deviations away from where it should have been. And so a gradual pullback should favor international stocks over domestic stocks in that environment.
You mentioned small caps, and of course, they're a lot more sensitive to any hint of a rate cut than their large cap brethren would be. Speaking of which, what could Jay Powell say at tomorrow's news conference that would surprise investors? We know what he's likely to say because it's been the same message for months now.
We actually think that the couple of things that we might hear tomorrow, one is going to be basically what the press release reads like. We'll get an idea as to whether there were dissenters on the vote, and there could be 1 or 2 dissenters on the vote. So that could be the first signal that we get, that there's dissenters actually saying the rate cuts are coming, even though there's no rate cut put in place, or the rate cuts should have been coming. The second thing, and we'll hear this in the press conference, is if the chairman takes a little bit more of a dovish tone in recognition of the conversation that he is probably hearing in the room today, and they will be hearing in the room tomorrow before the decision is released. Those two pieces together could be on the margin, construed as a little bit more dovish than his prior positioning.
All right, Jason, always great to catch up with you. Got to get you back without the distance that we've had from the past. Jason Pride is the chief
Would love to be in studio.
Absolutely. Chief of Investment Strategy and Research over at Glenmede. I just want to point out real quick, Scarlett, before we get to the equity markets, actually seen a huge amount of activity right now in the Treasury space. Volume has really picked up about 20% higher than where it would normally be at this time. Yields right now at session lows, particularly on the longer end of the curve, with your U.S. 30-year yield down 10 basis points at 4.85.
Yeah, pretty remarkable moves, especially at the long end of the yield curve. And usually it's gone in the other way, where people favor the short end of the yield curve.
Yeah, we'll try to get you some more details on that, and we're going to break down all of today's equity market action and break down all of the earnings results coming up right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic here with Scarlett Fu, taking you through to that closing bell with a global simulcast. Carol Masser and Tim Stanovic join us from the radio booth. Welcome to our audiences across all of our Bloomberg platforms, including our partnership with YouTube. A rare down day for the S&P 500 after 6 straight record highs. A bit of a pullback today, down 0.3%.
Yeah, it's like we're waiting for something, maybe a Fed meeting or maybe an earnings palooza, as our Finley Walker, our producer, has said. We've got Booking, Mondelez, Caesars, Electronic
Is she related
Arts.
to Luke?
What?
No.
What?
Just keep going.
You're tough, man. Visa, Starbucks, Frontier, and Avis. We've got a lot of earnings coming after the closing bell. And then, of course, we've got some big tech ones tomorrow and Thursday.
Yeah, Meta Platforms tomorrow, Microsoft tomorrow as well, Ford as well, Qualcomm. And then, of course, the big one, Apple, on Thursday.
And we also get details on how the Treasury plans to issue debt over the next quarter. This as we see Treasuries extend their gains. As Romain was just pointing out, this auction was better than expected. Surprise demand for 7-year notes.
And tomorrow's going to be really crazy because we think about the Fed meeting, the idea that you're starting the morning with actual hard economic data that presumably the Fed, I mean, I know it's backwards looking, but presumably they're not getting the report in advance. So you got a big GDP report, and then you throw that in with the Fed and all the earnings here. It's kind of understandable why some people might be on the sidelines today.
Yeah, absolutely. And we've had quite a run, too. Let's not forget that. And there are some folks out there that maybe think things are once again getting a little lofty.
All right, well, after 6 straight days of gains for the S&P 500, 6 straight record highs for the S&P 500, a modest pullback on the day. It takes a while for these numbers to settle, but it looks like the S&P is going to end lower by around 17 to 18 points, or about 0.3%. The Dow Jones Industrial Average down about a half a percentage point. The NASDAQ Composite down about 0.4%, and the Russell 2000 finishing lower by 0.6%.
All right, S&P 500, almost an even split. 256 names, Scarlett, to the upside, 246 to the downside.
All right, let's take a look at the IMAP. 7 sectors in the red, with industrials down by more than 1%. Carrier and UPS are the big laggards there. Consumer discretionary and healthcare also weaker as well. The gainers here, real estate investment trusts and utilities, each up by more than 1%.
All right, guys, we are getting earnings. Let's start with Booking.com. Avis also crossing the wire right now, but Booking saying the gross bookings in the most recent quarter came in above street estimates, $46.7 billion. EBITDA, $2.42 billion. Which is just slightly higher than what the street was looking for at 2.21. EPS, the bottom line, adjusted as always, 55.4. Street was looking for 50.3. So it looks like a beat on all of the main metrics, including on the top and the bottom line. $6.8 billion in revenue, 16% higher than 12 months ago.
All right, let's also take a look at Avis, the rental car agency. Second quarter revenue, $3 billion, pretty much in line with what analysts were looking for. The second quarter America's revenue also meeting analyst estimates as well. So if you break it down a little bit more, international revenue, $707 million, slightly higher than what was anticipated as well. We could see Avis down about 1% in after-hours trading.
Okay, I'm looking at what's happening with Caesars Entertainment. Second quarter net revenue coming in at $2.91 billion. Estimates for that were $2.86 billion. That's second quarter same store net revenue. Second quarter loss per share coming in at 39 cents. Overall, second quarter same store net revenue did beat estimates. Shares right now, well, they are unchanged.
All right, let's get to Corvo. That, of course, playing into the semi space and has had quite a run this year. The company, let's go right to the forecast. See second quarter revenue of about $1.025 billion plus or minus 50 million. See second quarter adjusted EPS, a range of $1.75 to $2.25. That is above what the street is expecting of $1.64. And let's go backward to the last quarter. First quarter adjusted EPS, 92 cents versus an estimate of 63 cents a share. We'll look for some color around that number because quite a gap there. And first quarter adjusted revenue of 818.8 million. Again, that seems to be a big beat. The estimate on the street was 771.1 billion. And just taking a quick look at what this company is doing here in the aftermarket as we bring it up, it's up about 14%. So I want to know a little bit more about those numbers.
Yeah, I do too. I do want to go back though to the 2 travel stocks that just actually reported, Booking and Caesars, both lower now in the after hours trade. And I am curious about this idea of kind of like where travel goes next. Booking, of course, not providing a hard forecast in the release, but when you take a look at what Caesars has to say, it gives you some sense here that while things are, I guess, stable, it does not necessarily seem to indicate that they're expecting any material growth from current levels going forward.
Yeah, absolutely. I'm just taking a look at the booking statement from the CEO, Glenn Fogel, talking about reaching a milestone with connected trip transactions. There's a 30% increase on Bookings.com's total transactions year over year, healthy growth across different verticals, especially with flight tickets up 44%. So again, it comes back to people's willingness to spend in this current environment, which, you know, is better than it was 3 months ago, but not enough necessarily for investors to feel completely comfortable with the company beating and exceeding their forecasts.
On that willingness to spend in this environment, Scarlett, we're getting some commentary from Tom Reeg, the CEO of Caesars, who says that in Las Vegas, we posted solid gaming results in the face of softer market demand in our hospitality verticals, but net revenue and segment revenue increased 4%, driven primarily by Caesars, Virginia, and New Orleans. So maybe people aren't necessarily trekking to Las Vegas as a result of uncertainty, but they're visiting these more regional areas and spending money there instead.
All right, I'm a little obsessed by the crypto space. I want to go back to Corvo because the company's chief financial officer, Grant Brown, saying the company's fiscal first quarter revenue and non-GAAP EPS exceeded the high end of guidance driven by broad-based demand. It made me want to go into the supply chain function of these guys. Their customers, number one customers, Apple, Samsung Electronics. I mean, it's a wide range of industries. But again, the stock up about 11.6% here in the aftermarket. And keep in mind, it's up about 21% year to date. So quite a bump to the upside here.
And just a reminder for our viewers, we're still awaiting to get earnings out of Starbucks as well as Cheesecake Factory. EA, of course, video game company, also expected to report sometime soon. But it gets to this idea, though, Carol, I mean, to your point, this idea of how these companies, the tech companies, of course, that you're referring to, how they sort of transition. Like, is this all about AI? Is this all, of course, about crypto as well? EA is out, so too is Starbucks. Where are we going, guys? Let's do Starbucks first here. Starbucks crossing the wire right now. The company saying that international comp sales, as expected, were flat, down about 0%. U.S. comp sales also were down about 2%. So a negative sign in front of that. But the good news is that comp sales were actually dropped less than what the street was looking for. The street was looking for a drop of 2.5%. Operating margin came in below expectations, 10.1%. The street was looking for 11.6% here. And the company overall basically saying that as comp sales drop on that 2% level, both in North America, the U.S., and of course flat sales over international, it is saying adjusted EPS coming in at 50 cents a share. I just wanted to double check that number. The street was looking for 65, so it looks like a miss on a lot of key metrics here. But again, this is a company where the quarter that passed is less important than the guidance that they give for the future.
All right, and to that end, let's take a look at EA Electronic Arts, the video game publisher. It has maintained its full-year net bookings forecast, sees it at around $7.6 billion to $8 billion. Analysts were looking for $7.8 billion. And then also saying that the first quarter net bookings for the quarter that ended was $1.3 billion, slightly higher than the anticipated $1.24 billion. It also sees earnings per share this quarter of about 29 cents to 46 cents and still sees a full year EPS at about 309 to 379. Stock moving just slightly lower in after hours trade.
Okay, let's go to Mondelez, the maker of Triscuit and Cliff Bars, among others, down about 0.3%.
That's 1%. Not Oreos and the good stuff?
Hey, you know what? I want to do the ones that people aren't necessarily familiar with. Bars, okay. If you go to Mondelez's website, the first thing there is
Oreos!
Triscuits. Come on.
Oreos.
This is a healthy world that we're living in.
Okay.
Well,
some of us, yeah.
The shares are ever so slightly lower in the after hours, down 0.4%. The company still sees fiscal year organic net revenue at about 5%. The estimate was for 4.95%. Second quarter net revenue above estimates at $8.98 billion. Second quarter adjusted operating margin 14.3%. Second quarter adjusted EPS above estimates at 73 cents. The estimate was 68 cents.
All right, we've got
they also make Chips Ahoy.
And Ritz crackers, Tate's cookies.
But that was the third thing.
Good
Tate's.
stuff.
All right, snack hour it is.
Tate's.
Right.
You can use your Visa to buy things made by Mondelez. Visa is out with third quarter adjusted EPS, $2.98 a share. That is better than the forecast of $2.85 a share. And third quarter net revenue coming in at $10.2 billion, folks. That too is a beat. The estimate on the street was $9.87 billion. Stock's been bouncing around, but right now it's up, remain up about 0.5%.
And just real quickly, Mara Holdings, kind of, I guess you call it, I don't know, the crypto energy company, 2Q EPS, $1.84. That compares to a loss from the previous quarter of 72 cents a share. So it looks like an improvement on the bottom line. Not a lot of analysts cover this, so hard to sort of match this up with street expectations. Shares higher by about 2.6% in the after-hour trade.
All right, and don't hate on Triscuits, as Tim would probably say at this point. I'm just going to lend it there. I should point out, too, Seagate's out. Fourth quarter revenue coming in pretty much in line. Fourth quarter adjusted EPS, $2.59 versus $2.45, the estimate. Stock, though, is down about 8.3% in the aftermarket, so we'll look for some more headlines on that
Western
one.
Digital down as well on the heels of that.
So pulling down the sector. All right, whoa, that's a wrap. A lot of earnings. Our our cross-platform radio, TV, YouTube, Bloomberg Originals. Scarlett and Romaine continuing there on TV. Tim and I continuing here on radio on Bloomberg Business Week Daily. We will see you again, same time, same place tomorrow.
Our coverage continues after the break. A slew of earnings, more to come, and a deeper dive into some of the ones that we have. Starbucks, Cheesecake Factory. Stick with us. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
All right, we had 6 straight days of gains on the S&P 500, 6 straight record highs, a streak that was broken today. A modest pullback down about 0.3% with some big drags coming from Apple, Nvidia, and Lilly. Dow Transports also took it on the chin, but that was a big drag coming from UPS, one of the biggest decliners across the tape today. You take a look at the drop in yields, much more significant on the longer end of the curve than on the shorter end of the curve, continuing now to play out that steepening story, and the dollar stronger for yet another day. As far as some of the individual movers, all of these are earnings stories for the most part. CBRE, a big real estate company, primarily focused on the office space, a big bump up today after its earnings really gave some encouragement to investors out there who were concerned about any sort of doldrums going on. Spotify, the opposite direction, concerns about its business model. Sarepta getting a reprieve from the government on that key drug that had been told to halt sales and shipments of. And Krispy Kreme, one of the, let's just call it meme stocks that got caught up in all the hype over the last few days, pulling back yet again today, down about 8%. And that brings us to our top story of the hour, and that is the health of the consumer. For every positive economic data point that we've gotten on that front, there have been just as many negative points to parse as well. That consumer confidence report that we got earlier today, well, it showed that sentiment is on the upswing. But at the same time, it also showed a reduction in plans for buying big ticket items like autos, appliances, and vacations. That JOLTS data that we got this morning, that showed that job openings are above pre-pandemic averages. But at the same time, it showed that the share of people saying jobs were harder to get, well, that swelled to a 4-year high. You got PCE data next Thursday that is projected to show a rebound in personal incomes and consumption. But then you had data today from the credit scoring firm VantageScore that shows debt delinquencies among upper income Americans actually rising, and rising faster than for middle and lower income borrowers. So this mixed economic data, it puts a lot more importance on the individual earnings and the individual commentary that we get from the companies themselves, the consumer-facing companies, the Bookings, Caesars, Visas, Avises, Mondelez's, Cheesecake Factories, and of course, Starbucks. All reporting earnings this afternoon, so let's get right to it. Starbucks, of course, one of the more notable names to report. They just came out with their earnings. Comp sales down, as we expected to be, yet again, as the new CEO, relatively new CEO, Brian Niccol, tries to engineer a turnaround. Joining us right now to talk a little bit more about this is Abby Roach, Senior Portfolio Analyst at Allspring Global Investments. And Abby, what was your first reaction to the earnings from the quarter that just passed? I know we were expecting softness, but was that softness in line with your expectations?
It was certainly on the top line. I think, we were hoping to see some better comp results, but really weren't expecting to see that this quarter, but we're a bit hopeful to see it, particularly on the transaction side of things. But from an EPS standpoint, we're a bit disappointed to see that in the operating margin miss. But all in all, from a comp standpoint, that's really been a big focus in terms of this turnaround. Encouraged to see that those numbers, particularly on the transaction side of things, when you look at U.S. transactions, which is a real big focus for the company with some of the initiatives that they're working through, those were flat sequentially. So encouraged to see in a tough environment that those were flat quarter over quarter.
When you look at average ticket prices, basically the amount of money that a person spends when they go in there, that ticked up slightly overall by about 1%, a little bit higher if you just look at the U.S., up about 2% here. What does it take? What do you want Brian and his new team to do in order to get that number even higher than where it is, that growth rate, I should say, higher than what it is?
We want them to be able to really bring those customers back into the stores, both the My Starbucks Rewards members, to be able to get them back in stores if they've lapsed, to be able to get them to increase the frequency with which they visit Starbucks. And then for those who aren't loyalty members, to really be able to get them, to bring them back into the stores and get the frequency up for them as well. But we think the number of different initiatives that they're working through, we're encouraged that they are really focused on bringing back the brand strength and that coffee house culture. And we think it's certainly a tall order, this turnaround, and it's taking longer than I think many would have initially expected. But we think they're doing a lot of the right things to be able to improve the brand and improve the experience for those customers.
And of course, there's been a lot of talk, not only, of course, about the idiosyncratic issues with Starbucks, but overall the health of the consumer, the health of the economy. I do just want to pause for a second and point out we are getting some earnings out of Cheesecake Factory, ticker Cake. That company saying that in its most recent quarter, the second quarter, it did actually see comp sales rise by 1.2%, which does appear to be relatively in line with what the street was looking for, although it is down from where it was about a year ago. EPS coming in at $1.14. That compares to $1.08 that it reported about a year ago, and adjusted EPS, we should say $1.16, and that is a beat over street estimates of $1.06. And Abby, I want to bring you back into this because Cheesecake Factory, in their earnings release, they do talk a lot about how the comp sales performance was actually above their own expectations, in their words. And they say that it reflects a healthy consumer demand, not only for its products, but overall. And I am curious that when you are looking at these companies and you're looking at the health of the consumer, are you finding validation of that idea that consumers are still willing to spend?
You know, I think it's mixed from company to company, but I think overall, really the theme thus far through earnings season, particularly with restaurants, has been the consumers are holding up quite well. I think when I think back to April, there was a lot more nervousness around the consumer and how the consumer would fare. I'm encouraged that thus far the consumer is still spending and we haven't seen a significant pullback in terms of their willingness to eat out at restaurants. So I think it is encouraging, this environment, and I think some of the differences you're seeing from a company to company standpoint are related to specifics as it relates to some of the challenges that those companies might be working through. But overall, encouraged by the health of the consumer and just really the resiliency that's continued.
I am curious, too, just kind of the juxtaposition between these two companies. I mean, both, I think at one point, a decade or so ago, were basically the place to be. We were all hanging out in Starbucks. We were all hanging out in Cheesecake Factory. And I feel like that luster has sort of gone away to a certain extent. Some of it self-inflicted, some of it just the natural evolution. Do you think that those types of chains, the sort of casual dining but sit down that Cheesecake does, and that coffee house sort of environment that Starbucks is in, do you think there's still, as a business model, there is a real growth story to that?
I do think there is. I think a lot of it depends on the execution. I think consumers still want to be able to get out and experience that experience of going to a restaurant or that coffee house culture that Brian Niccol has talked so much about at Starbucks. So I think there's definitely viability to this business model. But I think a lot of it, where some of the challenges have come in, has been companies really focused a lot on technology or mobile ordering and getting away from kind of that core experience within the stores, within the restaurants. And so it's kind of finding that balance now, we've kind of overcorrected in terms of the digital side of the business, and now being able to flip back sort of where we are today in 2025 with the consumer and be able to balance kind of that digital technology element of it along with the experience of eating, having a beverage in a restaurant.
All right, Abby, we'll let you get back to work. I know you got a busy day ahead of you. Abby Roach, Senior Portfolio Analyst at Allspring Global Investments. A closer look at Starbucks. Those shares up more than 3% in the after-hours trade. Cheesecake Factory Cake, those shares up about 1% to 2%. When we come back, we're going to look at the flip side, I guess, of what's been happening in the after-hours trade. Two big decliners, and they're both in the travel space, Booking.com and Caesars Entertainment. A conversation up ahead about the health of travel with Clint Henderson of The Point Sky. This is The Close on Bloomberg. All right, let's take a look at the travel sector. We just got earnings out of Caesars Entertainment, the big casino company, saying the same-store sales in the second quarter dropped by about 4.1%, down to around $965 million. And on the bottom line, the company reporting a loss per share of 39 cents. And then there was Booking Holdings. This was less about the quarter that just was and more about its forecast. The company citing, quote, increased uncertainty in the geopolitical and macro environment, saying that could potentially constrain its growth going forward. Clint Henderson is a travel expert over at The Point Sky, and he joins us now to discuss. And Clint, I am curious as to, I travel a lot, mainly for business, and it seems like airports are still crowded. Every flight I'm on is still full. Hotels, hard to book anything these days, at least if you're going to a big city. I mean, is there travel softness out there? And if so, where?
So the softness, it's really a tale of two cities. So you've got high-end premium demand holding up really, really well. That's why you see, marquee destinations with hotel prices of $500 to $1,000 a night and really expensive first-class seats, et cetera. But then you've got a lot of softness among the economy seats. So airlines are not selling the economy seats as well. Maybe there's some struggles at lower-end chains. I have seen stabilization, though. That's the word we're getting from C-suite executives that look, things were really rocky at the beginning of the year, but they've stabilized for the end of the year. What I'm really worried about is we had all this demand already baked in for the summertime, right? So everyone had booked their summer trips, but maybe the demand really starts to fall off in the fall. So that's where I'm really paying attention right now, is moving forward. I think the summer is going to be great for most travel companies, but that look ahead is a little scary right now.
I am curious if you have any insights into what's going on with international travel. And this is primarily anecdotal, but I mean, just walking around New York City, which of course gets a huge amount of foreign visitors, particularly during the summertime, it just appears to be a lot lighter. And this has been a topic of conversation amongst a lot of my friends. And I'm wondering if there's any actual data that supports the idea that we actually are seeing fewer inbound trips into the U.S.
Yes, there's tons of data. That's exactly what's happening. So you've got Americans still traveling as much as they have been the past 5 years, but international inbound travelers are dropping like a rock, especially in places like Las Vegas. Canadians and Mexicans not as willing to come to cities like San Diego or to Las Vegas because of geopolitical situations. So you started to see weakness, and we saw it in Caesars results, with Las Vegas demand being down substantially. So we're already looking at $12.5 billion in potential losses this year in the United States for inbound travel. Now, the demand has held up remarkably well for Americans going overseas, and I don't see any let up in that right now, but the inbound traveler is definitely down.
I am curious on the Vegas side, because there's been a ton of videos posted on social media of, empty casinos, people walking around Caesars or the Venetian or something, and who knows the context. It's always hard to know what's real and what's not. But if there is that much of a downturn, I am curious as to what you think sort of maybe reverses that. I mean, Vegas has always been good about finding ways to either to tantalize people to come back, whether it's through discounts or just other amenities. Do you see sort of something in their playbook that they can use to address any potential drop-off in foreign demand?
Absolutely. It's not just fall off in foreign demand for Vegas in particular. It's also domestic Americans are not as willing to go because it's gotten so expensive. There's just so many fees on everything when you go to Vegas now that it's made it out of reach for some middle-class consumers. And we'll see Vegas roll out the old playbook of free hotel stays, free parking. You're already seeing some discounts offered to fill hotel rooms. So I think that will return, especially if this trend continues. But I think, it's another example of the travel companies, hotels, everyone getting ahead of themselves with add-on fees, and the consumers starting to rebel a little bit from that.
We only have about a minute left, Clint, but I'm wondering if you can just push ahead to the holiday season here in the United States and what your expectations are with regards to travel, particularly air travel.
Yeah, so I am seeing some capacity cuts for fall and going into winter. So we'll have to see how that plays out. I imagine holiday bookings will remain strong, but it's really those periods, the shoulder season, off-peak, when airlines are struggling to fill those seats. And I think we're going to see a lot of deals. This has been the summer of savings, as far as I'm concerned, for flights especially. Hotels have been a little more resistant to that trend, but definitely some deal opportunities out there for consumers.
All right, Clint, always a pleasure talking to you. Always great insights out of you and really everyone at The Point Sky. Clint Henderson is the travel expert at The Point Sky. A closer look at some of those earnings that we just got in the travel space out of Booking.com and, of course, Caesars. Both of those stocks lower in the after-hours trade. And just a reminder, we're just less than 24 hours away from two gigantic earnings report. Microsoft and Meta, they report after the bell tomorrow, and we're going to break down what to expect out of two key pillars of the Mag 7. Dan Morgan, Senior Trust Portfolio Manager over at Synovus Trust. He's going to be joining us in just a second. Stick with us. This is The Close on Bloomberg. A fire hose of earnings here in the after hours. Let's round up some of the more notable movers. Nora Melinda, Natalia Kanicheva, and Denitsa Chakova joining us right now to break it all down for us. Apologies to both of you. Nora, kick us off.
Romaine, let's start with the biggest payment network in the world here. We're looking at shares of Visa. They're down right now, tumbling a little bit lower here, and that's after it actually was a pretty good report. We saw a beat when it came to revenue last quarter, coming up about 14%, but here we're seeing the guidance unchanged, and we're seeing Truist analysts really saying that a lot of these people in the financial space, investors, are really thinking that being good is not good enough, and that's what you're really seeing displayed here in our earnings report today, especially as we're thinking about EPS moving forward, increasing by a high single digits as opposed to revenue, which they see growing low single digits here, Romaine. What are you looking at, Natalia?
Hi, Nora. I'm looking at shares of Mondelez. They are now down by 3.2% post-market. It was a mixed report. On the one hand, the company beat when it comes to adjusted EPS as well as revenue, but adjusted gross margin came below expectations. For me, the most interesting thing was a global breakdown of organic revenue. It looks like North America took the hardest hit. So we see that organic revenue was down by 3.4%. Expectations were for minus 1.8%. When it comes to other regions, we see that Europe, Latin America, and Asia, Middle East, sales came a little bit better than expected. And also, Denitsa, we know that Mondelez already raised prices, but it still looks like U.S. consumers prefer some essentials over cookies.
Exactly. We're turning to video games, which is not necessarily essential, but we're seeing quite the drop there. Despite a pretty good report from Electronic Arts, they actually beat quarterly booking expectations. When it comes to profit, they scored about 200 million of profit. Their booking revenue was also pretty strong. We're talking about 1.3 billion, which is more than they had last year and more than the street expected. We also have their Formula One game really boosting the revenue this quarter. They have a lot of exciting releases, Battlefield 6, they have an NFL game, all coming within the next week or August. But clearly that's not enough to lift sentiment, especially when it comes to the outlook. And when we look at the year-to-date chart, we're up just 1%, and this earnings report brought no relief. Back to you, Romaine.
All right, thank you to Denitsa, Nora, and Natalia. A closer look at some of the after-hours movers on the back of earnings, and quite frankly, this is just kind of a palate cleanser until tomorrow. The Mag 7 really kick off the heart of the earnings season tomorrow, with Microsoft and Meta set to report tomorrow, and you can see Apple and Amazon follow it on Thursday. Daniel Morgan joins us right now, Senior Portfolio Manager over at Synovus Trust. And Dan, let's start off first with Microsoft, because this has kind of been, I think to a large degree, kind of one of the bright spots in the market. I know there's been a lot of talk about its high valuation, its high CapEx spend, but so far they've managed to justify that CapEx spend. And I'm wondering if you think that justification will continue.
Yeah, I mean, obviously looking, Romaine, for Microsoft to have a good print. You know, everybody's going to be zeroing in on Azure growth, as you've probably talked about before. The consensus is between 34 to 35%. And Romaine, you made a good point, which is they are one of the companies that we've been able to actually see some evidence that all this CapEx spending is actually helping them, because they're basically projected on this upcoming quarter to get about 17 percentage points directly related to AI in terms of growth in their Azure group. And they also have their Copilot, which has been a little bit disappointing at this point, but hopefully we'll get some positive impact to their M365 commercial cloud unit from that, and that could be potentially another leg of growth for them. But they've been kind of in the right place, right, Romaine? They're not, the DOJ's not after them. They don't have a lot of tariff issues, and they're getting positive impact from AI spend. So can it get any better for Microsoft?
Yeah, I mean, that is the question, and I think investors are looking, hopefully, for that. We should point out the shares are relatively unchanged on the day, so maybe that's a sign, given the rally, that some investors want to wait and see. But you did see a lot more activity today in Meta, and that was largely to the downside. Those shares lost about 2.5%. And I know expectations are high here, almost, I don't know if they're as high as the amount of money they've been spending to hire AI engineers, but what's the story that you're looking for out of Zuckerberg tomorrow?
Well, you know, Romaine, they've been hiring a lot of talent to come over to really beef up their AI strategy. And, you know, they're a little more difficult than Microsoft to actually see core evidence that they're generating positive impact from all the, you know, huge amount of money that they're spending. So, if you look at their initiatives, they've got a lot of different things going on. Obviously, they've got a lot of tools that they've developed to help their advertising revenue growth, which is expected to be up about 15% on the second quarter. They have an AI chatbot that they're very excited about. They're actually developing their own silicon, MTIA, which is their Meta chip that they're using to not be so reliant on, let's say, NVIDIA. But to be honest with you, Romain, it's kind of interesting because, they still generate almost all their revenue from advertising. You know what I mean? Mm-hmm. So it's a little bit different than Microsoft with Azure and Copilot and all these other initiatives where, okay, yeah, you're becoming more efficient, right, with these tools in terms of creating ROI for your customers that advertise, but that's still the driving force on, their multiple platforms.
But they've shown, I know a lot of people have criticized their over-dependence on ads, but they've shown time and time again, they found a way to continue to adapt to changing economies and changing sensibilities and find a way to even milk more ad dollars than we ever thought was possible. And I am curious that when you look at their strategy, or at least what we know about it publicly, and it does seem to revolve around hardware a little bit more than their past strategies that were much more focused on the social media platforms. If this is indeed a story about glasses or whatever other hardware they plan to roll out, does that change the dynamics of what they can make out of that, or is it still the same?
Yeah, I think that's what they're trying to do, right, Romain? They're trying to create these other avenues, right? We know that there's been headlines that you've talked about with the big data centers that they're building out. You mentioned the hardware, the eyeglasses, and so forth. They're also still construed as a leader in this AI initiative, right? They have Llama, which is kind of like Java, which I don't know how long you've been around, but if you remember Sun Microsystems, I've been doing this a really long time. So they're looked upon as kind of this leadership role in this whole AI initiative. So, eventually you think they'd want to get away from just monetizing, Threads or Reels or Instagram or WhatsApp and get into some other avenue. And I think they're trying to get there, but they're still kind of in transition in terms of not being so dependent just on that ad revenue base.
All right, I got to ask you, we got to push ahead just maybe 24 hours after this. We are going to get Apple. Probably one of the more notable laggards among big tech. Let's exclude Tesla. Obviously, those are Tesla issues there. But with Apple, I am just kind of curious as to why it is such a laggard, why investors just seem so negative on this stock. Is this kind of like the lack of innovation or what? Because they're still, splashing a lot of cash.
Romain, it's almost like a perfect negative storm, right? They had a new Siri tool, which was expected to come out on this new iPhone 17 release, which is coming up this fall. That got delayed into the second half of the year. That carried a lot of their, AI intelligence type of tools and so forth. So that kind of hurt the possibility of a big upgrade cycle for this year. If you look at revenues on iPhone, they're only expected to grow about 1.5% to 2%. Obviously, they are the poster child for tariffs, right? I think it's 85% of their manufacturing is overseas. So obviously that hurts them. Also, I don't hear a lot of people talking about this, Romain, but their service growth, they've got, 2.5 billion users. They really rely on kind of monetizing that user base through all these other services. That growth is actually slowing down. It's only expected to grow about 10% in this quarter, has been growing around 15%. So I hate to say this, and the stock has pulled back, right? Everybody's negative on it. But you have all these different things lined up that are just not working right now for Apple. So it's just a difficult situation.
Yeah, absolutely. And it gets to this idea. It's a difficult situation, but I do wonder if maybe that sets up for maybe a potential upside surprise.
Good point.
Yeah, absolutely. We have to leave it there. Dan, always appreciate you taking time for us. Dan Morgan, Senior Trust Portfolio Manager over at Synovus Trust. All right, we are keeping an eye on those stocks which report after the bell tomorrow. Meanwhile, some of the movers in the here and now after the bell, you see they're on the screen. We did get earnings out of Seagate. Of course, this is the memory chip maker. Those shares moving lower on the back of the company reporting a revenue for the most recent quarter that was relatively in line with estimates and adjusted EPS also, but guidance here coming in a little bit light for its fiscal first quarter. Avis Budget getting a modest bid on the day after beating on both the top and bottom line. Starbucks missed on a couple of key metrics, but you see the shares moving higher as a lot of people looking forward rather than backwards and still waiting on some earnings out of Teradyne there. You see those shares slightly higher in the after hours trade. This is the close on Bloomberg. All right, it's time now for our top three. This is where we name drop the people driving some of the day's most talked about stories. And we start with Shailesh Jejurikar. That's the chief operating officer over at Procter & Gamble. Well, at least for now, because he's set to take over as CEO. The company said he'll replace John Muller. Sticking with the C-suite, Nike veteran Maggie Gauger is set to succeed Athleta CEO Chris Blakeslee. Gauger has been with Nike for more than 20 years. And third on the docket is Scott Bessent, the Treasury Secretary, wrapping up another round of U.S.-China trade talks, saying that the two nations will continue to discuss extending a tariff truce and that President Trump has the final call. Let's bring Joe Mathieu into the conversation. He's the co-host of Bloomberg's Balance of Power. And what exactly does that mean? Is the president's called? I mean, didn't we hear from China already saying that there was a truce, or did I misread that headline?
Yeah. No, and that might have been the problem here. Maybe the Chinese jumped the gun a little bit here, Romaine. The rollout was not the smoothest choreography. After an hours-long meeting in Stockholm, the first headlines that hit the terminal were coming from the Chinese themselves. Then Scott Bessent and the U.S. trade rep Jamieson Greer, who was also representing the U.S. in these talks, ended up with doing a pad and pen with reporters in a hallway, while a room full of other reporters from the U.S. and other places was holed up in a room for hours waiting for them. They finally got in there and held a news briefing that we carried live here on Bloomberg. And it was pretty clear that the Chinese had spoken a bit early. Scott Bessent said he would bring this back to the president in an Oval Office meeting for tomorrow. I should note, Romaine, that the president, while at that same time briefing reporters on Air Force One, said he had already spoken with Bessent. So I think there's just a little bit of theater going on here as they try to slow the roll and give the president the chance to sign off on what was agreed to here. But let's be honest, what does appear to have come from this meeting is simply an agreement to meet again.
Do we have any sense of when that will happen? I mean, isn't there still kind of a trade deadline hanging? I think, what was it, August 12th? I sort of lose track of some of these dates, but I think August 12th was the deadline. So, I mean, in theory, I mean, that's 2 weeks away.
They were working against an August 12 deadline, you're right. What we understand is they were talking about a 90-day extension, so another 90 days would give us some time to continue talks and maybe arrive at a venue and a date for the president, Trump that is, to meet with President Xi, to maybe get a real deal underway here. But it's pretty clear, Romaine, they still have a lot of stuff to talk about.
All right, Joe Mathieu is the co-host of Bloomberg's Balance of Power. You can catch him at the top of the hour right here on this network that you're watching. But we continue our discussion here on The Close about trade, and an interesting warning from the IMF earlier today about a, quote, precarious trade backdrop that it says could weigh on global growth through the end of 2025. Now that, of course, gives the Fed a lot to consider, with the central bank due to make a decision on rates tomorrow, with one less governor present due to a personal matter. Wendy Edelberg joins us right now, senior fellow in economic studies at the Brookings Institute, and a wealth of experience in the halls of our government. I am curious, Wendy, about this idea of even trying to sort of factor in the impact of trade on the economy as the Fed tries to make a decision. There's still so many loose ends, as Joe Mathieu was pointing out. You know, these are frameworks of deals. And of course, the nitty gritty is going to take weeks, if not months, maybe even years to complete.
That's all true. And the chaos has just been enormous. But the big picture is still pretty clear. So inflation is only running moderately above the Fed's target. But unlike in 2024, when all the factors were pointing to moderating inflation, which was great news, now we have this major factor, tariffs, that we know is going to push up inflation. And so that's got to be on the Fed's mind. I know it is. Of course it is. Powell has said it is. And that is one of the best reasons, I think, that they'll have for standing pat at the next meeting, at tomorrow's meeting.
When people talk about the inflationary impact of tariffs, there's been a lot of discussions, not so much about just how much that impact will be, but how fast it will sort of appear. Like, will it be sort of very gradual and incremental to the point where the economy can kind of digest it, or will it be kind of one of these all-at-once types of things, kind of similar to what we saw during the pandemic, where people all of a sudden went to the grocery store and realized everything was, 20% higher than what it was the last time they went?
Well, we are in uncharted territory, so anything I'm going to say is going to be speculative. But I think after the beginning of August, we will have effective tariff rates that are on the order of about 18%. And what that will likely mean is that, in my estimation, is over the next 2 years, we will get an increase in the price level of about 1.8%. So think of that as happening, roughly speaking, over this year and next year, an increase in inflation of perhaps 1 percentage point this year and 0.8 percentage points next year. So those are notable numbers, nothing like what we saw in 2022 and 2023, but notable.
I am curious about the pressure, the public pressure that has been put on Jay Powell to lower interest rates, not necessarily as a hat tip to its dual mandate, but more in service of the idea of additional fiscal spending, additional Treasury issuance, and other fiscal policies that they're looking for some sort of counterweight. I know it's not the Fed's mandate to do that, but do you think that we could see the Fed maybe try to be somewhat accommodative to the wishes of the White House?
So the short answer is no. The longer answer is, as much as the very large increases in federal borrowing make Trump want lower interest rates, that's not how it works. When the federal government goes into the market and increases borrowing, that pushes up interest rates in private markets. So even if the Fed did nothing, even if it just stood pat, because interest rates are rising in private markets, simply standing pat makes policy less accommodative. More accommodative, less restrictive. So what that means is that the more federal borrowing we have, the more the Fed actually has to increase interest rates. So Trump's got it all backwards. Of course, he would love to have lower interest rates on the federal debt, but we can't just wave a magic wand and lower the Fed funds rate and lo and behold have lower interest rates on the federal debt. What of course would happen and has happened in other countries is that if the Fed were to artificially keep rates low in order to make interest rates lower on the federal debt, all that's going to get you is higher inflation, and all inflation gets you is higher interest rates. So one way or another, Trump's going to have to face higher interest rates on federal debt.
And he also gets to this idea, Wendy, about investor expectations, the idea that the reaction function to the Fed isn't always what it does. It's about what it communicates and what people think it will do. So if everyone in the market believes that the next Fed chair, whoever that may be, is going to be way more dovish than the current Fed chair, do you run the risk of having inflation expectations unanchored, unmoored from reality?
It is absolutely true that the more President Trump harangues the Fed, the more he is probably buying himself higher interest rates from any FOMC that is trying to remain credible. I'm a little puzzled by all the market expectations that are coming out of market prices. On the one hand, the Fed funds futures market suggests to me that the market expects the next Fed chair, the one put in place by Trump, to only put in place cuts in the Fed funds rate to the tune of 0.4 of a percentage point. That is way, way less than what Trump has asked for. So I find that puzzling. And then on the other side, we do see inflation expectations creeping up in a worrying way. The surveys of consumers, while they're not incredibly reliable, do suggest much higher long-term inflation expectations. That's the really worrying part. Market prices that you can see in Treasury yields suggest higher long-term inflation expectations. In the ballpark of where expectations were in 2022, 2023. When the Fed was feverishly raising interest rates to keep inflation expectations contained. So I am seeing cracks in the market that they are worried about the next Fed chair.
cracks. How do you rate so far how Powell has actually held up in all this? I mean, he's been pretty stoic. He dodges all the questions at the press conference when people ask him about his future. Do you think he's doing a good job in handling this?
I think he's doing a great job. I mean, the entire weight of the Trump administration is coming down on his shoulders. And in the face of all of that, he's standing tall. You know, of course, we can talk about exactly how he's handled, you know, the overruns in the cost of the Fed construction project. They wobbled a little bit on that, but you know, I can't even imagine the pressure that he's under, and I think he's performing admirably.
All right, Wendy, I have to leave it there. Appreciate your insights. Wendy Edelberg,
Thanks.
there, former chief economist over at the Congressional Budget Office and now a senior fellow in economic studies at the Brookings Institution. When we come back, we're going to set you up for what to watch over the next 24 hours that could move markets, including that big Fed meeting. This is Bloomberg. All right, let's push ahead to what the markets will have their eyes on over the next 24 hours. A slew of earnings coming down the pike that they're going to have to digest, including before the bell tomorrow with Hershey's, Etsy, Kraft Heinz, Adidas, and Wingstop all reporting. And then after the bell, you're going to get results out of Qualcomm, Robinhood, Carvana, Lam Research, Ford, eBay, and of course, two of the biggest weightings in the S&P 500, Meta and Microsoft. Economic data also going to dominate the tape tomorrow with that prelude, that drumbeat to the monthly jobs report on Friday. The ADP employment numbers come out, and we're going to get the first look at second quarter GDP numbers, as well as the quarterly personal consumption and income figures. We get a U.S. Treasury quarterly refunding announcement as well. And of course, the star of the show tomorrow is still going to be Jay Powell and the Fed. A decision and a press release at 2 p.m. And of course, a press conference at 2:30 p.m. Our coverage on Bloomberg starts at 1:30 p.m. with Team Surveillance. The Fed decides. Tune in tomorrow for all of your market moving and coverage right here on Bloomberg.